The country's premier financial minds have delivered a stinging indictment against the Finance Bill of 2026. Appearing before the Departmental Committee on Finance and National Planning, the Kenya Bankers Association and ISPAC are demanding a uniform 5% cut on pay as you earn, warning that a crushing wave of statutory deductions has pushed workers to breaking points. Beyond the pay slip, they warn of a severe economic freeze if the state goes ahead with plans to tax mobile money and seize corporate cash. NTV's Sylvia Kadhoni Muse breaks down the high-stakes battle over your money.
It's outrageous that corporates are paying taxes at 30%, but individuals are paying at 35%.
The math simply doesn't add up anymore, and the country's top financial experts are no longer sugarcoating it. Leading the charge is a fierce demand for immediate income tax relief.
The high rates of taxation for employees, which are also coupled with SHA, affordable housing, NSSF, put together on employees, are quite high. What is happening? It is shifting, it is tilting the ground, and now there is high preference for being in what we call side hustles or rather informal sector. Not that the informal sector should not be taxed, but there's a chance that actually people avoid taxes there.
The finance bill's appetite for revenue doesn't stop at your payslip. It aims squarely at how you send and receive money. Financial stakeholders warn that slapping a 16% VAT on mobile phone fees will instantly roll back decades of progress.
You know, if you look at the impact of M-Pesa in this country and what M-Pesa has done, I think it would be a very, very sad thing to impose VAT on M-Pesa and essentially negate the financial inclusion that we have been able to see as a result of M-Pesa. If you think about the lower segments of society, Mama Mboga and so on.
And then comes the battle over corporate survival. Bankers are putting up an equally spirited fight against a highly controversial clause that gives the Kenya Revenue Authority, that is KRA, subjective power to force companies to distribute 60% of their undisputed profits as taxable dividends.
What should be the threshold? Because the idea here is, in spirit of what you said about certainty, about all that, is can we have a threshold?
Based on the taxpayer and the commissioner, I believe it should be left to the commissioner and the taxpayer to determine what then is optimal for that specific business and that specific sector. Because right now, there is no problem with the open-ended nature of that provision. If then we were supposed to cap, why then not put a maximum?
The fine print of the Finance Bill 2026-2027 reveals that an aggressive revenue dragnet targeting the basic infrastructure of daily Kenyan life. The state aims to double excise duty on mobile phones and strip away crucial tax relief from local smartphone assembly plants, a move accountants say will flatly crush local tech jobs and inflate device costs.
A huge segment of Kenyans, we buy renewable energy powered phones, which are on a pay-as-you-go plan. And these ones are actually assembled in Kenya. I think we've got 3 device manufacturers or assemblers, let's say, in Kenya, 4. So if you exempt these inputs and the items, it means that they cannot claim the input VAT on sale. Again, meaning that they become more expensive. And, you know, I saw some simulations which we're happy to share. Simply as a result of this and excise duty, the cost of this product is going to go up by about $56 per unit or per...
Sylvia Kadhoni, NTV.